Hi, today I'm speaking to Peter Lightfoot and Kevin Brown of RBS. We're seeing right now an unprecedented amount of regulation at global and regional level, which is really making it difficult to assess the impact on payment. So Kevin, I'm going to start with you. Which pieces of regulation do you think have the greatest impact on the payments industry?
Certainly from our perspective as a transaction bank operating across 38 plus countries, one of the challenges for us is the combination of the global regulation and the regional regulation, and also how these different pieces of legislation are implemented. So if we look at some of the examples, certainly of late, the PSD in Europe and whilst not direct legislation originally, SEPA now becoming regulation in terms of its implementation, it does have a major impact on the way you do business in those countries. It focuses on building transparency and certainty for customers and standardisation. But when you're operating in those countries and you're looking to provide a standard offering for your corporate clients who are also operating across a number of countries, it's quite difficult when you see different interpretations of that regulation being implemented. If you look at wider than just the payment legislation, you look at Basel III, certainly that has an impact on payments in the sense that it's looking at the liquidity that sits behind those payments and increases the cost of those payments in terms of the liquidity charges that banks have to make against those activities. I think more fundamentally though, and I think we hear this from our corporate clients as well, is that the volume of change, whether it's pure regulatory driven or it's things like AML and sanctioning driven, is just swallowing up resource in terms of implementation of change. And it's not always just single change, it's change on change. And when I look at our development portfolio, that means that that limits for many organisations the amount of money that is then spent on innovation. That said, I think when you look at some of the specific regulational changes, maybe for instance use the example of faster payments in the UK, some of that change gives you innovation that allows you to really drive your customer proposition forward and deliver real value for both your corporate clients and if you've got a big retail franchise as well. So it is a real challenge at the moment, and I think for most transaction banks, it's making sure that you've got the right prioritisation around the activity. It's also working closely with the regulators to understand the local interpretation. And then driving that through into your customer proposition, looking for opportunities to really enhance the delivery that you give to your corporate clients.
So, I mean, we can talk a bit about drivers for this regulation, but taking on what you were talking about innovation and resources, isn't it really this sort of regional interpretation that's taking up a lot of these resources at banks?
It is to a degree, but it's also just the general volume of activity. So we're trying to implement changes on complex payment systems as well as our low-value, high-volume payment systems. And as you do that, you're impacting your clients as well in terms of changes that they need to make. And it's quite interesting. The latest SEPA regulation has taken a step further in terms of requiring some of the corporate clients to make changes in the way that they submit. So this is extending the regulation around payments into the corporate space as well. And that's going to have a real impact on certainly some of our bigger clients that operate across Europe. But it's not just a European phenomenon. So when you look at, for instance, Dodd-Frank in the US, certainly the latest dialogue around some of the changes for cross-border payments and the requirements to provide information to the remitters at the time that they make the payment is going to have a profound impact on the way those cross-border payments are made. So that the whole sort of regulatory approach is changing the proposition. And it's interesting when you go back to the drivers behind the regulation. And you know, from a bank perspective, you know, we fully support the sort of prudential approach that is being sort of pushed forward in some of the elements of this. So ensuring that we've got the right amount of collateral and support for those payments, that systemically they're sound, and we've got the right risk profile around who we're paying and how those payments are transmitted. But the regulation goes a lot further. It looks at transparency, for instance, you know, with the PSD, the transparency of activity for the retail client so that they know what they're getting and the timeliness of that payment transaction. But also standardisation. So again, making sure that, you know, the regulation has got the right level of standardisation in terms of activity within a country. And here I think you do really see the conflict, because you get the interpretation element coming in. And you know, we've seen it time and time again. You know, the one thing I would ask regulators is to share experiences and try and align your operational interpretation and understand what that means for both corporates and banks operating across multiple jurisdictions. I think then sort of, you know, we in the UK, I think, have been at the forefront of elements of this with the FSA changes, which again, you know, have started to you know, drive a strong degree of prudential regime into what we do, but have also extended into not just the payments themselves, but the intraday space. And I think, you know, Peter will no doubt elaborate further as you look at the, you know, the impact that that's had on, you know, the intraday positions in the UK and the general FSA intervention.
Yeah, that moves on to my next question for Peter. I mean, Peter, are there many national regulators following the FSA's approach to liquidity?
Well, I think, as Kevin said, the FSA are certainly in the front of this. I think other regulators and central banks are looking at it. I don't see many are as far as the FSA. Certainly in the Netherlands, the DNB are, in that they want very, very detailed responses. In the end, they're looking at systemic risk reduction and controls, and you have to prove these things to them. And that needs data, needs a lot of data. And it also has brought about accountability. It's raised the profile of the intraday piece high up into banks now, that the numbers are large and it needs very, very detailed controls.
So what will this impact have on banks and corporates alike?
Certainly it's a far greater amount of data is needed, but also it's down, I think, to the banks to sort of help look at what their provider is giving them.
It sounds a bit costly. I mean, what are banks doing to reduce that cost?
It is going to be costly. Collateral these days is expensive. There's the need to term fund it increasingly, so you're not reliant on short-term markets. So it's down to the individual provider banks to make sure their customers have got the information they need. It's down to the actual payments themselves, the banks making and financial institutions making their payments. Are they making them as cleverly as they can? Are they making them efficiently? It's also down to the industry as a whole. You know, are we making the most of the payment systems? Here in the UK, the RTGS is implementing a liquidity savings mechanism. That should help the payment banks reduce liquidity, so therefore in turn there's less costs that may well won't need to be passed on to the individual customers. So there's a long way to go. There's other areas in terms of data capture. There's RBS have arranged via SWIFT a liquidity implementation task force, which Kevin chairs, which is going some way to looking at consistency of data, for example.
Yeah, Kevin, can you tell us a little bit more about this task force?
The task force came together really out of you know, a piece of work we did internally in response to the FSA liquidity assessment process. We realised then that we needed a great more deal of detail around our intraday liquidity, and whilst we could sort of drive some of that internally, there would be a great deal of value from trying to look at how we could standardise that across the industry. So we, with Swift's help, pulled together a number of banks to look at this particular area. and that work's continued through to looking at, you know, not just sort of the interpretation of messaging, but, you know, potentially augmenting existing messages or potentially creating new messages. Recently, that's now come together with a similar broker group that's been looking at the same issue, and we've realised that the two sets of requirements dovetail together neatly. We've produced an initial liquidity guidebook or rule book, which is to try and set some of the guidelines down in terms of how these messages are interpreted. But clearly this is just a first step in a journey, and that work's continuing both with the banks and brokers working together to look at how we can build and enhance those requirements from a, you know, bank and broker perspective. I think Peter could probably tell you a little bit more about some of the impacts of that in terms of our own work internally.
Yeah, what this brings is more consistent and accurate reporting. If you actually have made a payment, you know it's gone, you know what your actual position is. So it benefits your intraday real-time position, and also when you start looking back at historic data, you've got very accurate data. So when you need to produce your graphs, etc., showing your natural intraday profile to the regulators, from which you then may calculate how much collateral you need, you've got much more accurate, important data. And from there, hopefully, we can show where inefficiencies are in the payments world, work on them to bring those down, and again, try and maintain the systemic risk control at as cheap a cost as we possibly can.
That's great. Thank you very much.